Do you see that banks will maybe start loosening their qualifications a little bit as home prices continue to go up and less, first-time buyers can buy?
Yeah, I think the ones that are going to loosen up are the first-time home buyers. I think that they see the problem with millennials going into the marketplace and getting priced out. I think that that's a nationwide concern.
Welcome to another edition of Tuesday Tips with Brent and Lee. If this is the first time you've been to my channel, my name is Lee Brickey, and here we talk about real estate, mortgages, and money. And on Tuesday, we talk mortgages with Brent Starts from Unitas Lending. So for a buyer right now out in the market looking to purchase a house, what can you do for them? How are you structuring? I know we have with United Wholesale Mortgage, we have this lock and shop. How can something like this help buyers over that period of time when they're looking to finance?
That's a great question, Lee. We've got some great programs to help in this situation because we can lock out before we even have a home out 90 days. And then if we were in escrow sometime during that period and we need an extension, we can extend it as well. So it's, and to answer your question, long-term, what do I see? Certainly the trend is higher rates right now. So I would recommend, someone coming into the marketplace looking to shop for a mortgage is certainly kind of put that backstop in there to mitigate the risk of rates rising even higher.
Right.
So I think that would be the prudent thing to do if you're thinking about moving to this area, is to get a nice long lock if you're under construction, as soon as you can, and that would be a backstop for rate risk.
Or someone planning to come to Florida the next 2 or 3 months, go ahead and get their, or planning to buy here in Florida in the next 2 or 3 months, go ahead and get their loan locked early. So that, right. Or just at least get all their stuff, all their paperwork in and information in, so that, you can talk about that, because that's a really important thing too, is how you watch every single day for the right time to lock. Because when somebody's looking for a house and you have all their information and they're approved, you can then watch the market and see a dip and lock them right then.
Yeah, well, perfect examples. This morning, Chairman Powell was in a meeting with business owners, and it was not really a scheduled or, at a podium or anything like that. During a meeting, that notes were taken, basically said we need to get really serious about inflation. And so on his, remarks and some notes they took at that meeting, those were released publicly. And the bond dropped 88 basis points this morning, forcing us to do what's called an alert to lock. So we have about 15, maybe sometimes as much as 20 minutes for rate sheets to adjust up. And so we had that alert and locked our pipeline this morning. We also have alerts to floats too. So if there are situations where there's geopolitical unrest, like bad news out of Ukraine, for example, then we'll have an alert to float. Hey, it looks like rates are going to improve in the very, very near term, like literally 15 minutes.
Right. And you and I also, we talked earlier about article coming out talking about the impact of rising rates and home prices. And over time, as rates have risen, home prices have also gone up too. But we have a real affordability issue right now. In my opinion, it's because rates remain so low for so long. It's raised housing prices dramatically because, fortunately and unfortunately, a lot of people were able to get into homes that never would have been able to, or wouldn't have been able to buy as much home as they could have when rates were, in the 2s and even in the low 3s. Now with rates going up, and we're at right now about 4.5, 4.6.
Right. That's where we are.
So with, we're talking about a full rate jump from January.
Right.
I mean, 1%. Right. So that's a lot.
That's a big drop or big increase in such a short period.
That's a big increase, right? So with the home affordability issue already being an issue, rates getting up this high, you know, you've been around for a long time, 25 years in this business. Where do you see, you know, this going right now with, do you see home prices slowing down some because of rates being so high that it's going to slow the market at least a bit? Because nationwide right now with real nationwide, I'm on, you know, I was just on a call, you know, an hour ago, a Zoom call with agents all over the United States, and you know, everybody's experiencing no inventory, and bidding wars out of control, and prices continuing to soar, and rates have moved, you know, almost 2 points since last year. So
Yeah.
where
Well,
where does it
nationwide,
stop with these housing
yeah.
prices, right? I mean,
Well, yeah, well, you know, inventory, that's the word, right? We hear, and basically we're 5 million residential units shy. It's a true housing crisis. There's just not enough supply at all. And that's just, you know, basic economics is going to come to play, the supply and demand. There's very low supply. And now the readily available capital is starting to shrink up, you know, the higher rates. And, you know, that is changing and evolving, but it's actually it's behind the curve, if you will, because really, if you look at, you know, historically what interest rates can be, especially in highly inflationary environments, you know, we're seeing, you know, in the 70s, we're what, 80s, 12%, you know, was the average interest rate over the course of the 1980s, you know, so, you know, so we can go much higher. You know, so you know, we were blessed by a number of baby boomers coming into the market and you know, basically upscaling in the late 80s as well. So so that really, you know, kind of solved that, because, you know, there was additional building going on. It was a great big boom at that time. So and supply had to increase. But I think, you know, we're going to see, you know, interest rates, and because at the beginning of the year, people were shocked when people came out and said, you know, hey, rates could be as high as 4.5 this year, and we're already there. You know, I think that
right.
it's happening faster than what people had thought.
Well, and you know, I typically, if you if inflation's 7.5%, and I know no one wants to hear this, and but if inflation's 7.5%, which I don't believe that everything's being pulled into that, housing prices aren't being pulled into that. We're not looking at gas prices right now. I mean, a lot of fundamental things that people are using every day is not being pulled into that number. So, but let's just say that we agree that inflation 7.5% right now, mortgage rates need to be 7.5%.
Yeah, I know no one wants to
Correct?
hear that, but that's kind of what that's about right, Lee. And you know, as you know, rents are going up at that rate. You know what I mean?
Oh,
If you
they
look at
are.
what rents have done in St. Lucie County, I mean, look what they were last year and look what they are now. I mean, you know, it's not going to, as long as that supply problem is there and people are moving, and the migration pattern is what it is. There's really not an end to it. I mean, you know, it's disconcerting for the locals here. You know, first time home buyers are trying to get an FHA loan approved, and they lived here all their lives, you know, and they're 25 years old, getting married and wanting to buy a home. It's a challenge for them to compete with what's happening from out of state buyers. And like you say, Broward and Miami-Dade.
Right. And and just so people understand, tell them why an FHA buyer may have more issues than a conventional buyer.
Yeah, a couple things. It's less down, right? So when we show that purchase price with the approval letter with the loan amount at 96.5% of the purchase price, many sellers and realtors, frankly, will basically say, hey, this person doesn't have any money. They must be a credit problem. There are issues. Whereas, you know, someone paying all cash, there's none of those problems, right? So they don't have to worry about a timeline. There are an FHA loan requires a different set of standards as far as the appraisal. The appraisal is to protect the homeowner, you know, because it's presumed that they've never bought a home before and may need some additional protections, which the FHA loan appraisal does. So it may, you know, require additional improvements to close the loan based on, you know, and the seller is going to be asked to make those improvements or changes to the property.
Right. So,
Yeah.
but where is the kind of low end to conventional loans right now where someone can get a decent rate on a conventional, because there is a 3% down program if you fall into that, and then
Yeah.
but there's 5% too. So on a conventional loan, where would they fall into where where they need to be as far as credit, so that their closing costs wouldn't be outrageous and their rate would still be, reasonable?
Conventional, they're getting picky. I mean, those rates really improve around the 700 range, 720. Anything below that, it's FHA might be something you want to look at just for the pricing. However, the mortgage insurance, that's a cost benefit analysis that you need to look at. How long you're going to be in the property. If you're going to be in the property and it's kind of a step up property, you're not going to have it for more than 2 years or so, 3 years, then FHA is not a bad option, because you get a rebate on the upfront mortgage insurance, and they get the lower rate, and you don't have to worry about refinancing anytime soon. FHA typically, that mortgage insurance is going to be in place for 11 years. So, that's a consideration. So conventional is better if you can do it, as far as, getting rid of that mortgage insurance. And at the rate of appreciation we're seeing right now, Lee, as you know, so many of the people you sold homes to 2 years ago, they're already out of their FHA loans. They have no mortgage insurance. So,
Right.
and sitting on $80, $100, $150,000 worth of equity, a lot of those
Right.
folks.
No, it's crazy. It's crazy. The average homeowner right now has $300,000 net worth, where the average renter has $8,000. I just put that out the other day. It's a crazy number. So
It is.
So what's your advice for buyers right now, and that are trying to get into the market right now? What's your advice? Should they hold out a little bit to see what happens, or do you think they should pull the trigger as soon as possible? And if rates go down 6 months from now, they could refinance if it went down significantly. Because I don't see home prices slowing down this year. I mean, I don't see it. I see home prices in Florida, especially, in double digits.
I do too. And I really don't, I'd rather see a healthier market, personally, because I like the stability of, 5% a year increases. That's a wonderful investment. If you're anywhere around 4 or 5, even 6%, and you're borrowing that money, right? Then the bigger figure is the purchase price. Let's say you borrow, 80% of the home's value, and let's say the interest rate and the rate of appreciation is exactly the same. The overall investment is increasing at a higher rate. So it's been a bit of arbitrage in recent years, because you're borrowing such a low rate, and then the overall property is highly leveraged, and so it's been a great situation. And I think, I'm with you, Lee. I don't think it's going to change. I think that, it's got a ways to run. We've talked about this before in previous, YouTube discussions, but I've seen what happened in California. I can see, it's got a ways to run, because the demand is so strong, and there's just a supply problem. And, people start renting rooms out. They do all sorts of things for affordability, getting, gifts from family members, whatever it takes, because they realize, like you said, $300,000 in net worth versus 8,000 for a renter. And rents are going to be, one day, the average home in St. Lucie County will rent for $8,000. I'm going to go on the record right now. And everyone's like, you're kidding me. There's no way it'll never happen. Maybe not in my lifetime, but maybe in yours, Lee.
Right.
It's going to happen. It's going to happen.
Well, I mean, this year we're pushing $1 million homes easily by the end of the year. That are there than now, but I would say there's going to be way more of them in Port St. Lucie by the end of the year. And I know Matamy's opening a new neighborhood, and those homes are going to be in the 800,000. So, we'll pick up this discussion again later. But one thing that we are seeing is there's more programs coming out. So talk about the new program that just came out for guys like us that are self-employed.
Yeah, it's a great program. As we know, a lot of self-employed people have, discretionary expenses. Sometimes they'll take expenses in one year versus another. And so it can get really tricky qualifying for a loan. And so what we've done, we've searched out some of the best investors for bank statement loans. So as opposed to using tax returns, we look at deposits over 12 consecutive months for the business, either business or personal. If you're running all your business through a personal account, that's fine too. It's just one account looking at those deposits. And then we look at, let's say those deposits average $10,000 a month, for example. Basically that with a letter from your CPA or accountant that basically says, hey, the expense ratio for this business is 20% or $2,000 of that 10,000 per month. The income is qualified at $8,000 per month. So whether or not your taxes show that, we would go off that bank statement and CPA letter as far as calculating income. So it's a great way with a 640 FICO score. Those programs start to come into play and are available, and up to $3 million. So it's not a small loan and doesn't have any mortgage insurance. So a lot of benefits to the self-employed borrower looking to do something that basically looking at their tax returns, they wouldn't qualify, but there are other options.
Now, do you see that banks will maybe start loosening their qualifications a little bit as home prices continue to go up and less, first time buyers can buy?
Yeah, I think the ones that are going to loosen up are the first time home buyers. I think that they see the problem with millennials going into the marketplace and getting priced out. I think that that's a nationwide concern, not just here in Florida. And so the current administration seems to be leaning more favorably to that concern versus doing anything to help investors. If you're an investor, I don't see things improving for you anytime soon. You're going to be paying that 20% down to get a single family rental. Rates are going to be a little higher, and that's basically going to be the trend, I believe.
Well, and quite frankly, in my opinion, if you're an investor, you're an investor. But
Right.
home ownership is I think something important, especially in times like this where we're having inflation and rental prices are getting just out of control. I mean, right now, you can purchase a house even at 4.6 less than you can rent a house. So
Right.
pretty much anywhere. So I think that, that's really where the focus needs to be, because you just can't have a market where, nationwide, and that's what it is right now. It's a market that's nationwide where an FHA loan is almost impossible to get accepted. We love people, and we try to help them in as many as we can. We've done some deals in the past where, I believe that they would have never purchased a house if they would have not had us on board. I mean, I'm not bragging about us, but I am,
Yeah.
so, I think this housing crisis is a real problem, and it's something that it's going to remain to be a problem right now. And when you're seeing these numbers of first time buyers not being able to have a chance in home ownership, and they're, a lot of these millennials and are making very, very good money, but that downstroke of having to come in with closing costs and down payments is very, very difficult for a lot of them, especially with rents going up and now food prices and gas prices added on top of that. I mean, it's very difficult for a family, even if they're making 100, if they're in 100,000 a year, between the two of them, when you're paying an extra $3,600 a year to live, it changes the game. Plus your rent's 500 to 1,000 more than it was, 2 years ago. So
and student loans the millennials have right now too.
student
It's just
loans, everything included in that it's crushing people right now. So
it
hopefully
is.
we can see a change in the market. We'll keep people updated on it. Every week we were doing this on Tuesday, so it's not all bad news. It's good news too. But right now it's I really feel for a lot of people out there, that we would love to help, but it's just becoming an issue.
It is, unfortunately, but I think, a normalized market is ahead. I'm encouraged for the long-term picture. I know that real estate is a great investment. Like 30 years from now, you look back and you think that's the best thing we ever did. Homes are now $3 million. You know what I mean? And
Right.
rents are 8,000 a month. I mean, really, I mean, if you look back and just extrapolate and go back, where rents were, 30 years ago and where prices were 30 years ago, it's stunning to think the difference if you bought then versus not. I mean, a lot of folks can do the math. We should do that sometime, Lee, where we can just really do the math and show the difference long term and why that $300,000 net worth in a homeowner versus 8,000 net worth for a renter, and really show the numbers in a granular type of basis.
If you have any comments or questions for Brent or myself, please leave them in the comment section below. We answer all your comments, all your questions. We love to get them. And if this is the first time you've been to my site, please don't forget to slap that subscribe button right there, ring that notification bell so you don't miss any of our real estate tips and tours. Be kind to each other, and we'll see you next time.